a company growing revenue nearly 700% in a year, whose stock just fell about 30% from its high because its single biggest customer just became a competitor. Welcome back to Wall Street Holic, markets, shares, and options. This is research and education, never financial advice. Today, it's Nebius, ticker NBIS, at $209.47 as of July 7th. That 30% drop, gift or warning? Our verdict, moderately undervalued, but only just, and at medium confidence. Base case fair value is $250, about 19% above today's price. Blend the bear, base and bull scenarios, and the probability-weighted value lands at $233, roughly 11% upside. What's capping our confidence? A July 1st Meta overhang we'll unpack shortly. So, what is Nebius? Picture a landlord for artificial intelligence. It builds and runs massive clusters of NVIDIA chips, plus the software on top, and rents that compute to AI startups and enterprises. Spun from the former Yandex, renamed in 2024, it's now a NASDAQ 100 member. About 98% of revenue is this cloud. Here's the edge. Nebius owns the entire stack. Power, chips, networking, software. Power and land are the real bottleneck in AI, and it locks them up early, like a gigawatt-scale site in Pennsylvania. Add preferred NVIDIA access and a push into higher margin inference, and that's a moat rivals can't easily copy. Now the growth, and it's staggering. Group revenue jumped 684% year over year last quarter. The core cloud, 841%. Annual recurring revenue, last month's cloud sales times 12, hit $1.9 billion. One caveat, a big reported profit was a one-time accounting gain, so ignore any trailing price to earnings. It's noise. The quality metrics cut both ways. The stock trades near 6.7 times projected 2026 exit ARR, the multiple to anchor on. But Nebius still loses money, burns cash, and faces a $20 to $25 billion capital spending bill against barely $3 billion of revenue. The growth is real. Profitability is unproven. Now, the overhang. On July 1st, Bloomberg reported Meta will sell its spare AI compute, stepping straight into Nebius's market. The stock dropped 17% that day. The twist? Meta is also Nebius's biggest customer on a $27 billion deal. Bear red, a giant undercuts pricing. Bull red, Meta's just dumping excess, not truly competing. This is the entire debate in one line. $20 to $25 billion of annual spending against roughly $3 billion of revenue. Execute. Power online, chips installed, contracts filled, and ARR compounds towards $7 to $9 billion at healthy margins. Slip on delivery or demand, and that same fixed cost base turns brutal. The demand is locked in and huge. Microsoft up to $19 billion, Meta $27 billion, plus a $2 billion NVIDIA stake. Nebius raised over $6 billion this year. But two customers dominate that backlog, which is exactly why Meta's move stings twice, hitting revenue and moat at once. How big is the prize? Total AI infrastructure spend tops $1 trillion this decade, with specialized GPU cloud a $300 to $400 billion slice. Nebius targeting $7 to $9 billion of ARR is still low single-digit share of an undersupplied market. The binding constraint everywhere is supply, power, and chips, not demand. Against rivals, Nebius sits between pure-play CoreWeave and the giant hyperscalers. Its edge is vertical integration and owned power. Its weakness is scale, tiny next to Amazon, Microsoft, or Google, who each spending over $100 billion a year, a nimble disruptor, but the bargaining power of its huge buyers just rose. Zoom out. Nebius is a high beta bet on the AI capex cycle. It swings harder than the market, amplifying both the boom and any reversal. As a pre-profit builder, it's sensitive to interest rates and financing costs. Its real edge is securing power early. Its real risk, a demand pause that hits neoclouds first. On management, founder Arkady Volozh built and scaled Yandex before this, and the team has repeatedly beaten its own ARR guidance, real credibility. The watch items. A dual-class structure hands founders voting control. Shares are up 20% from dilution, and executives filed sizable stock sales in early July after the run-up. Ranking the risks. Number 1 is Meta and hyperscaler competition crushing pricing. The analyst puts 37% odds on it breaking the thesis. Close behind, CapEx and financing strain, plus customer concentration, both around 30 to 35%. Then execution on that power build, and they're not independent, they compound. If you like our earnings breakdown and you want to get the full, clear, and unfiltered information, don't forget to like, share, and subscribe. How do you value a company that doesn't earn money yet? The primary tool is EV to ARR, enterprise value against recurring revenue, at 5, 8, and 10.5 times for bear, base, and bull. A forward sales multiple cross-checks it, and a cash flow model is down-weighted as too dependent on distant guesses. Reset consensus is near $237. Here's the math. Bear $145 at 37% odds, base $250 at 45%, bull $370 at 18%. Weighted together, that's $233, about 11% above today. But the spread is enormous, $145 to $370, a 2.5 times swing. Treat it as the center of a wide range, not a precise target. The bull case. The sell-off overshot a still undersupplied market. Demand keeps outrunning supply. Nebius hit $7 to $9 billion of ARR near 40% margins, and Meta proves an opportunistic reseller, not a real rival. The optional Meta tranche resells at healthy margin. The multiple re-rates toward 10 times ARR, and the stock reclaims $300 plus. The bear case, equal weight, Meta and the hyperscalers flood the market with cheap compute, turning NeoCloud into a low-margin price war. Nebius's 2 mega customers hold the pricing power. The optional tranche goes unsold, and a huge CapEx bill collides with a cash-burning, debt-financed model. The multiple D rates and the stock slides toward $145. On the chart, the picture's damaged. The stock broke from its $299 high and is testing support near $206. Below that, $180 to $185. To repair the trend, bulls must reclaim $240, then $270. For context, this traded at $44 a year ago. So who's this for? Growth investors wanting direct AI infrastructure exposure, who can stomach 30% plus drawdowns, and long horizon holders willing to scale in through volatility. Who should skip it? Anyone needing income, capital preservation, or valuation comfort. No dividend, deeply negative cash flow, and a second quarter print that could gap either way. Mark your calendar. The big one is second quarter earnings around July 29th. That print largely settles whether Meta is ramping or stepping back. Then watch whether the optional Meta tranche gets resold and whether Missouri and Pennsylvania power comes online. Exit 2026 is the real test. Does ARR actually reach $7 to $9 billion? Now the options playbook, and the call is stand down. Implied volatility, the market's expected swing, spiked near 119%, and the house rule bars new structures above 100%. Premiums too inflated into a binary event. If it cools below 80%, a cash-secured put near $180 support makes sense. Getting paid to potentially buy lower. For now, own the shares, and options always carry real risk of loss. The 3-price ladder makes it actionable. $140 is the no-brainer, deep discount zone. $250 is intrinsic value, the anchor. $370 is the bull high. At $209, you're between the floor and fair value, the moderately undervalued zone. The plan, accumulate in tranches from here toward $185, add harder toward $145, and don't chase above $270. For the series scorecard, NBIS lands moderately undervalued, price $209, probability weighted value $233, medium confidence. This refreshes our prior Nebius deck. Price drifted lower and the street trimmed targets, so expected value eased slightly, but the verdict holds near the fair value line. The final verdict, moderately undervalued, medium confidence, high variance. The move, accumulate the underlying in tranches from around $209 toward $185, adding harder toward the $145 zone. The 30% sell-off left price about 11% below fair value, while guidance held. Don't chase above $270 until Meta clears and stand down on options. To wrap the outlook, short-term, volatile and cautious into that second quarter print, mid-term, constructive if Meta confirms as a customer, long-term, bullish with risk. $7 to $9 billion of ARR at 40% margins would justify much higher levels. Fundamentals score a 7 out of 10, technicals a 5. Real growth, real demand, real risk. Take it in tranches, not one lump. And that's the thesis. A hyper-growth builder trading about 11% below fair value, with a genuine Meta binary hanging over it. Quick reminder, this is research and education, not personalized advice. Figures are current as of July 8th. Prices move and options carry risk. So verify live data and consult a licensed professional before acting. Here's what makes this channel different. The same repeatable, fact-based process on every ticker. An honest medium confidence call instead of fake certainty. And the bull and bear cases weighed fairly. No hype thumbnails, no flip-flopping. If that's the research you want, subscribe, hit like, and share it. This is a subscriber-led channel. When enough of you request a ticker, it genuinely gets made. See you for the second quarter print around July 29th.
This video is for entertainment only, reflects the creator's opinions, may include stocks they own, and is not financial advice.